Why are we experiencing turmoil? What are the causes of this? Simply put, the S&P is down this year. Market turbulence and volatility have been massive. Many factors are at all-time highs. But what we know for certain, we are all getting whiplash and uneasy about how crazy the stock market has been. If this is your first webinar with us, welcome. We do these monthly and we dive into topics like investment strategies. We go through different markets and different insights on those markets. And the backdrop of everything we make sure is economics based. That's the foundation of everything. So if you see me throwing around overly dorky terms and you want me to dive in on what I'm talking about, I will sometimes throw around some economic terms that I really want to make sure that you guys understand well, because they are big impacts on what we're looking at today. Also, this is politically neutral and this is no pitch, as always. We will talk about investments that we see as good opportunities. Oftentimes we're taking those opportunities, but the point is that this is a no pitch presentation, that really we're drilling down on the data, we're drilling down on the information, and we are going all the way focusing on that. We will have a link in the chat for you to book a call with us. So if you want to learn more about what we're doing in the marketplace and how we're addressing a lot of the challenges that we'll go through today, you could book a call and talk directly with our Investor Success Pro. And Luke will be able to walk you through exactly what we're doing, why we're doing it, and you guys can learn more about that at any time. I personally am super passionate about these topics, so it gives us a good opportunity of just something that's more of a passion project at many point in time. And a lot of the topics that we'll cover today are not being covered in mainstream media. I believe, and our team believes, that's a massive disservice to the investment community, and it doesn't paint the full picture. So we want to dig into topics that you're not seeing, but are extremely important. Jim Cramer is an example of a mainstream media personality, host, etc. He takes a lot of flack. I'm sure everybody's heard the name and even tuned into a show at different points. But when you dive into Jim's performance, you'll see things like him underperforming the S&P 500 by around 2% on average most years. And this is the guy that they've dubbed as a professional enough to step into the market on TV, giving us all advice. His worst years are, something like 10% underperforming on that side. So we want to give you the full story here today. What are we going to cover? We are going to cover how to navigate the market chaos that we're all experiencing, the losses that we're seeing in the year, and what you can do about it as an investor to avoid more losses throughout this year. We'll go over market conditions. We'll go over the most vulnerable factors, the most vulnerable places in the market today, as well as some portfolio protection strategies that you can implement and take home with you by the end of this. But first, in case we haven't met, my name is Nick D'Angelo. I'm president at Saint Investment Group. I love the investment community. I love the real estate community, and I feel pretty blessed that I get to be recognized as a thought leader. I get to do podcasts every single week. We get to do big presentations like these, and I get to be on stages talking about exactly these topics that I'm really passionate about. So I'm also proud to say that on our performance side, that we have had amazing performance, a great track record that you can see on our website. And currently we have our income fund. It's our flagship offering that has over 500 mortgages that back it up. It's in over 21 states and growing. We have over 200 million in assets under management. On the high end, we pay a fixed rate of return up to 14.28%, depending on the share class and what you choose as best for you. So these are fixed returns. We have never missed a distribution to our investors in over a decade. So we've been always on time every time. And we're proud to say that we feel your money is safe with Saint. I love this slide. This represents a decade of hard work, tons of amazing investors, and this is just a brag slide, simply put. So over our 7 successful syndication exits, we've averaged over 35%. We have distributed over 13 million to our investors, over 200 million in assets under management, and over 10 years of on-time consecutive distributions. But but I always encourage you to not take my word for things and for you to dig in. That's what this presentation is. That's why we have infinite charts and data and sources, and we quote where they all come from so that you can check for yourself. So I encourage you guys, check us out. If you want to know more about us, check out what our investors have to say. We have a ton of good information on the website, different reviews that our investors have given us. Check out Trustpilot. Check out Google. I mean, just Google us, right? Check us out. Get to know us a little bit. These are a few amazing individuals that have a lot of great things to say about us. They happen to be CEOs. We have a great community with a lot of business owners. We seem to attract a lot of people that are on the high-end business side. So a few great people that we can't say enough good things about. And then again, we pay up to 14.28% returns. You can get a monthly check backed up by real estate investments, which is powerful because when we look through the data today and the numbers, especially in equities, is kind of what we're digging into today, there's some huge concerns. So we find real estate being rock solid in many areas with many good opportunities. And we have great returns that are backed up by real estate and not as exposed to things like the stock market. So before we fully dive in, here's a quick overview of how today will go. First off, we're going to start off with a legal disclaimer, make the attorneys happy. Then we're going to cover the topic. We'll do some light housekeeping at the end. And then the Q&A is at the very end here. And this is open. This is live. We're all talking together. I'm live here right now. So the questions that you ask, we will be having conversations on. So again, if you have questions along the way, drop them in the chat. I can either address them at that moment or we will save them for the end and make sure we get to everybody. So quick disclaimer, a word from our legal team because we love our attorneys. I encourage you to read this slide, but here's the big takeaways. This is not investment advice. This is for educational purposes only, and all investments carry risks, okay? Past performance does not predict future results. All right, now we get to have some fun. So for those that are new with us, we have a really cool bonus for our webinars that we started a handful of webinars ago. We do free book giveaways. This is for the best contributors. We want to work. We want to hear from you guys. We want to interact with you guys. We want to have fun with you guys. These are for the best contributors. These are for people that are leaving comments, that are engaging, that are, making interesting takeaways in different slides. So we give away a book each week to not only incentivize you guys to jump in and give us, some good insights along the way, but also because it's created a pretty cool community along the way. I am an obsessive reader. If my brain's not working and trying to learn new things and expand, then I'm never really fully feeling engaged. So I read quite a bit, and the books that I'm looking for are pretty much exclusively nonfiction and things that are going to change how I understand topics. This book right here, The Art of Strategy, is what I found as the most approachable and most interesting book on game theory. Okay. So if you don't know game theory is basically a breakdown with a mix of mathematics, strategy, and human nature all coming together to understand why people make decisions and how to make the best strategic decisions throughout your life. I love this book. I think I read it back to back 2 or 3 times because I liked it so much. So we want to give you this book. If you just want to go buy it now, then we left a link for you. We don't get a kickback or anything on this. This is just so that we can have conversations with you later. How'd you like the book? Was it as impactful for you as it was for us, etc.? So there's a link to the book, but we want to give you this book. We want to give this book away to you, okay? So here's again the ways that you guys can earn a book. This will go to the best contributors, the best people that are engaging with us. Comments in the chat. That's going to be the #1 place for us all to interact. Comments in the chat. Number 2, questions in the chat. If there's something you want to learn more about or something that's interesting to you that we should cover, drop a question in the chat and we'll jump in on it. 3, responding to polls. One really cool tool that we utilize throughout this presentation and through all our presentations, we utilize polls because we'll ask a question and you guys can engage with that with an answer. What that allows you to do is not only to, throw your vote in and see what that would look like, but also see what other people are voting. It gives you the benefit of seeing, we have a ton of people today, and it lets you see what their votes are on the different topics that will drop in. This will be investment strategy. This will be curiosity questions, etc. along the way. And last but not least, we love hearing from you guys and your experience with us. We have tons and tons of different reviews throughout the, Google, Trustpilot, etc. So if you leave a review for us, then let us know, okay? And that will enter you to win a book with us. Okay. Kevin, how are you? So we don't do mortgage-backed securities. I'll just answer that out of the gate. We don't do mortgage-backed securities. We do invest in mortgages, but they are not a securitized mortgage in that way. So mortgage-backed securities, like we saw many years ago, we don't invest in mortgage-backed securities in that way, but we do buy mortgages in bulk and also do hard assets. So I'm happy to answer more also on the later part of this. So let's jump in. The current market. What are we dealing with? Why are we dealing with it? What's going on? And what are the biggest factors in the marketplace today? Okay, let's kick this off by focusing on stocks, particularly, which is the big focus of this. Why are we experiencing turmoil? What are the causes of this? Simply put, the S&P is down this year. Market turbulence and volatility have been massive. Many factors are at all-time highs. But what we know for certain, we are all getting whiplash and uneasy about how crazy the stock market has been. Why is this? Well, there's a number of factors. First, there's the Trump factor. Next, we have sustained high inflation. We have a reluctant Federal Reserve. We have declining business sentiment. We have sky-high government outlays, aka they're spending like crazy. And as the data will show, we have a lot of severe market correction concerns in the marketplace. And then Jim, self-directed IRAs, highly encouraged. It's one of the most strategic vehicles that people use and most strategic strategies that people use to invest with us. Lots of good info there. I'm happy to dive in on that. So let's start peeling back the layers on market concerns. What are the different reasons that are causing these market concerns? First off, we're seeing a very interesting thing play out with inflation. I have beaten this to death on different webinars, but we are seeing 3% roughly inflation, which is exceeding the Fed's target of 2%. We see that a lot of this is caused by, or that a lot of this causes interest rate uncertainty long-term. A lot of this causes recession uncertainty long-term. New tariffs are impacting this because we'll dive in a lot on tariffs throughout this presentation, but they are inflationary. They are naturally inflationary at face value. And then there are geopolitical tensions. When you throw things like tariffs in, it does impact relationships with other countries. So trade's disrupted. We have multiple wars going around. We have new trade partners, right? Mexico overtook China as our #1 trade partner in the last couple of years. And Mexico and us have a, tentative relationship. There's some tension there at times, right? All these factors lead to one thing. I could give you a million reasons, but there's one big takeaway. It's uncertainty, okay? Us as investors, we as investors, when we experience uncertainty in a market, this drives many problems and it makes many people hesitate. What is driving a lot of this uncertainty and what is driving a lot of these market issues? We found 4 key economic factors as the drivers behind this. One note here is that these 4 economic factors, these 4 economic issues, are also often the driver of market crashes. There's a big overlap there. So what leads to market crashes? 4 things. The first is speculation. Okay, excessive speculation on companies, on pricing, etc. This inflates asset prices beyond their realistic values. Simply put, think Nvidia, think Tesla. I mean, honestly, think the entire Magnificent Seven right now. As of this month, as of the beginning of this month, the Magnificent Seven's PE ratio stood at over 28%. Or excuse me, stood at over 28. Okay, the PE ratio of over 28. These are staggering numbers. These are staggering numbers, and we'll show you the charting so that you get an idea of what that really means in comparison historically. Second, geopolitical tensions. These are things, these are the wars, these are the political instability, even domestically, and how that affects our relationship with countries abroad. We have trade conflicts, tons of uncertainty, some zigging and zagging, right? As Trump, whether you think he's a genius or you think he's a knucklehead, the reality is there's a lot of whiplash when he says he's going to do one thing, and then maybe that strategy shifts, right? It makes us have more uncertainty. Next, we have economic indicators. These are the scary numbers that come out, like GDP growth going backwards or declining altogether, unemployment rates going the wrong direction, manufacturing output and different industries having economic weakness, things that are concerning, right? These prompt sell-offs in the marketplace, and then that speculation gets a lot worse because what ends up happening is things have been driven up, and then the rebalancing of those pricing really affects the markets like we've seen in this short period of time recently. Also, technological advancements, right? We're talking things here like AI. We're talking things like AI and how that will affect jobs specifically. What do we see in the future for AI? Is it white collar jobs? Is it blue collar jobs? Is it all collar jobs that will be affected by AI in the future? And how do companies react to many of these changes? These are all the biggest factors, and they make it a very complicated spectrum of what we are seeing today. So, and again, this is the overview. Each of these we're going to beat up and dive in very deep on throughout this presentation. But the first poll that we have for you, we want to hear from you guys. The biggest question is, Ange, if you could cue up that poll. Guys, what are you most concerned about in the investment markets today? Whether that's stocks, whether that's inflation, tariffs, geopolitical, AI, what are you guys most concerned about in the market? Yeah.
I'm just having trouble. The polls doesn't seem to be loaded in here working properly. So I'm
It's a little buggy. Okay, well then
it's a little
we'll
buggy.
ask you guys.
Maybe they could just drop it in the chat.
Exactly right. So you guys, let's ask you to drop it in the chat. What are you most worried about in the markets today? Is it stocks, inflation, tariffs, geopolitical? Is it wars? Is it AI? Let us know. You guys drop what you're most concerned about in the investment world today. Yeah, I agree. Stocks, yeah, inflation and AI. Andrew, you've been with us on a few. You know that we've really dove in on inflation. I'm up there. Trump, there's some uncertainties that people have around Trump. Volatility, without a doubt. AI, instability, AI, tariffs, wars, geopolitical. I mean, we have a ton. Yeah, I agree with you guys. So we're all on the same page is what we're saying, right? What we're seeing is that there's really a small number of things, and different parts of the investment world are getting their lumps from these concerns more than others. So let's dive in. Let's learn more about what that might look like. Economic warning signs. Let's start digging into what the data is showing us. The Atlanta Fed, so the Federal Reserve in Atlanta, has a tracker called the GDP Now tracker. What this GDP Now tracker suggests is a likely decline in US GDP for the first quarter of this year. Okay, that is bad enough on its own. The bigger issue is that this is a drop off from the previously expected growth that we had. Okay, when we see this historically, many times this is an early indicator of contraction or recession incoming. Something that is an early warning of a recessionary force coming in the future. This is simply put a signal that we look for at times like this, especially from a very, very solid source like the Atlanta Fed. So preceding market crashes, this is one of the biggest telltale signs. What exactly are some of the reports showing? Well, we're seeing that the US economy is expected to grow in 2025 and 2026, but with tariffs and other factors that are now being added to the mix, we are seeing these expectations dampening. So in this month, the annual GDP growth rate was cut. The expectations were cut from 2.1 to 1.7. Okay. Comparatively, that's a 20% decrease. So it's not a small number that we're talking here. We are now seeing expectations decline. The trend is going the wrong way. And part of speculation in a market is that, simply put, it's emotional, right? So now we're seeing that the data is less optimistic. So then what's the impact on optimism declining in the stock market? Historically, this has absolutely been a signal that's impacted stocks in a negative way, especially on pricing. If the future looks worse than we expect, then investors expect worse results from companies. That drives down the PE ratios, those crazy numbers that we were just looking at. And effectively, that drives down share prices, which is what we're experiencing right now. So if only there was a way for us to quantify how consumers and investors, AKA everyone on here, right, how we feel about the market and the economy, right? Well, there is. The good news, we can see this. We can see consumer spending. We can track consumer optimism. And we're going to take a look at those numbers in a moment as well. But if only there was a way to also track the major drivers of consumer confidence. Well, there's a way to track that too. We're going to take a look at that as well. We can see unemployment as very closely tied to consumer confidence. So we will take a look at unemployment as well, the drivers of that, and how and why people are feeling about the economy today. Simply put, we have unemployment rates going up and consumer spending going down, okay? We see rising unemployment rates and consumer spending that is going the wrong direction, with trends actually increasing and not moderating at all. The forecast for unemployment is now at 4.4%. So I'll geek out with you guys for a minute. I'll talk, I'll use some dorky economic talk. There's something called the Phillips curve in economics. And what that is the balance of unemployment and inflation. So the Federal Reserve of the United States has what's called a dual mandate. They have to balance two things above all else: unemployment and inflation. The target for inflation is 2%. We're close to 3 right now. The target for unemployment is 4%. We're actually 4.4 right now. We've reached a weird point where the Phillips curve is completely out of whack. Now the Federal Reserve has really difficult decisions to make, because typically this is a seesaw effect. If one goes better, one goes worse, and vice versa, that they correct each other and have a good balancing factor. We're seeing both go the wrong direction. So unemployment, if less people are employed, then they are making less money. That's obvious. And if consumers are seeing less people unemployed and they're experiencing that more frequently, then they will be more likely to have a less optimistic outlook on the economy, which leads to less spending. And then they start investing more conservatively and spending their money more conservatively. This drives down company revenues because people are spending less, which reduces performance. And then therefore we see this in the public markets and companies taking a major hit along the way. And then when you go back to the investment side and they're looking for more stable investments, the demand for things like stocks goes lower. These two factors, consumer spending going down and more conservative investing, these are snowball factors. They affect stocks dramatically. And we have seen many points in history where these two items have converged to create massive issues in the stock market. That's what the numbers we're seeing today indicate we're in a similar situation of. And then we have the tariffs, right? The impact of new tariffs. There are many tariffs being discussed right now, but here's a few of them. 25% tariffs on Mexico, 25% tariffs on Canada, an additional 10% being on China, right? There is an unusually elevated uncertainty around the economy with all these tariffs floating around. Here's what we know about tariffs if you look at history. Two things. One, they're inflationary by nature because things cost more with tariffs. We know that to be the fact, right? Additionally, they are a short-term pain in nearly every market condition. But let's talk about some of the opposite side of tariffs. Tariffs actually have a lot of benefits also. That's why you saw things like the Biden administration keep many tariffs and many economic policies in place, even from Trump's first term, right? Because they have the benefit of protecting a country's industries. It allows countries to domestically have an advantage versus the imports, okay? You saw Biden's CHIP Act, which was directly focused on trying to bring manufacturing back to the US. Now you see Trump on the other side of the aisle with a huge focus of bringing manufacturing, bringing industry, bringing companies onto US soil specifically. So this is not a political argument. You see both sides actually making a lot of these changes. Trump's just a little more aggressive, right? And he uses tariffs a little more interestingly. But I want to be clear, both sides of the aisle, generally speaking, are pushing for manufacturing and industry to be back on American soil. So the benefits, what are we actually seeing in dollars and cents? We are seeing major investment into the US. We are seeing Taiwan Semiconductor agree to invest billions into the US. I believe it's Arizona, Scottsdale area, Phoenix area for their new manufacturing facility. You see Hyundai for 21 billion that they just announced that they're opening in the US. Honda for billions being invested in the US. And even Apple Computers agreeing and committing to bring 500 billion in investment into the US over the next 4 years. These are big investments into the US. So tariffs cause a lot of uncertainty, a lot of concern. They definitely impact inflation, but we also have seen over 1 trillion investment into the US as a benefit of tariffs along the way. But again, very painful in the short term. And this is why past presidents have been extremely careful to use tariffs sparingly. Okay. Trump is using them in a unique way. Past presidents, it was mostly to bring manufacturing and to shore up jobs in the US. Trump has used them as a negotiation strategy for other reasons, right? You saw this with Colombia. It's an interesting approach that many have not taken, and it has caused some instability in the markets. The benefits of that are yet to be seen, or the problems of that are very clear today. So long term, we don't really have a full gauge on what that looks like, but we do know it increases in uncertainty in the short term. But we do know the tariffs have brought 1 trillion plus in investment to the US today. So let's take a look at market behavior. Let's start at volatility index, the VIX. So for those of you that are drilling down to the stock market quite a bit and you know a ton, this will be a lot of basic information, but the VIX is something that's so important that we can't not cover it. So VIX is a literal index that tracks the volatility in the stock market. So it's a pretty good gauge to check how volatile the market is at any one point, and also to see the expanded trend over a period of time. A higher VIX reflects increased market uncertainty. It reflects more fear in the marketplace, more zigging and zagging. We recently hit a 6-month high in the volatility index to give you guys an idea of where we're at today. We're also seeing negative market performance. The S&P 500, the 500 best public companies in the United States, showing negative performance for the year, right? But the problem with the S&P 500 is that we're also seeing mid-cap and small-cap stocks lagging behind the big guys, lagging behind the large cap stocks. I'm a huge proponent of small business in the US. I believe it's the backbone. 99% of businesses in the US are small businesses. And frankly, when small businesses fail, it reduces competition. This is bad for capitalism at the most basic level. So seeing the mid cap and the small cap and smaller companies struggle in general is not a good sign for the market. Also, we've talked about this, but excessive speculation. I'll quantify this and say that if you run the data, that the level of speculation we're seeing in the market today is approaching the dot-com bubble of 2000 levels. This is especially present in the tech sector, right? You look at AI, anything that slaps AI on it is getting these crazy expectations, these crazy PE ratios. And then market overvaluation in general. High valuations on stocks, especially in the US, that professionals are saying absolutely unsustainable over the long term and really, really dangerous for the market. Just showing a picture here. This is AAII. This is a sentiment survey that goes out. We're going to show you guys the results of that because it's very powerful. It's a check-in of what we as consumers and investors are seeing, what we see in the market, what we believe in the market. These are the results. So the AAII, the American Association of Individual Investors, the sentiment level that they are seeing in their surveys claim that over 60% of retail investors are bearish on the market today. The percentage of bears in its survey increased from 40% just a month ago. So we have increased by 20, there's 20% more investors that believe we're in a bearish territory in the market in just the last month. Not only that, this is the most bearish that their survey has been since the middle of 2022 when inflation was over 9%. Okay. And even more stunning, this is only the sixth time since 1987 that we have been this bearish. Okay. Only 6 times in history in the last 30 something years has the market been this negative, that investors have been this negative about the market. So this is really good insight. This third-party group that provides us insight as what we investors feel about what's going on in the stock market. And then this is an illustration of VIX. We can see a handful of years here, what it's looked like over, we can see the highs here. Can you guys see my cursor, by the way, Ange? Yes, I think so,
yes,
right?
Yes, we can.
Okay, great. Perfect. So what we're seeing is that the expectations thank you, Michael. I appreciate that. The rest of 2025 is looking rocky as well as we dig into the projections in a moment. Performance-wise, I said it's bad. I said it's negative. I like to qualify statements. I want to quantify and qualify. The major US stock indices in the US are negative for the year, right? So we're only about a quarter in, but still, we're in negative territory by a good amount. If this performance continues at the rate that it's at now, the annualized returns of these indexes and of these indices would be the Dow Jones down around 8%, the S&P 500 down around 14%, and NASDAQ around 31% negative. So with these numbers, with the VIX being what it is and showing a lot of volatility, and with investor sentiment actually going lower, we see a lot of negative variables that likely will lead to a poor year of performance in the stock market ahead. But let's take a look at the biggest of the big in the S&P 500, the Magnificent Seven. This is where we start to peel back the layers of that dot-com bubble 2000, era of just massive speculation. We see a PE ratio of the Magnificent Seven of north of 28. Not only that, with the lower investor sentiment and optimism, this should decrease, meaning that most analysts are only seeing these go down over the next period of time. By how much, we'll show you exactly. And then again, this is just another survey showing that B of A, that their investors believe that 89% believe we are in for a rocky road ahead. So multiple sources showing negative expectations. The drivers behind this look negative, and 2025 does not look like a great year of stocks. Turmoil was used deliberately in the titling of this webinar. I'll just put it that way. All right, let's get geeky. Let's get into some really data-driven analysis here. This is some third-party data from a very reputable source to help us understand the market we're in reference to past markets and overheated, underheated, or well-balanced, okay? This is the Shiller PE CAPE ratio. This is called the cyclically adjusted price to earnings ratio, okay? When you see this CAPE ratio of a stock market, what it's telling us is the standard metrics of the market are being used to evaluate whether a market is overvalued, undervalued, or fairly valued, okay? The blue area is the fairly valued range. So if you see this ratio go above, the market's overvalued. If you see it go below, the market's undervalued. We can see that today's market, especially in the last few years, but especially today, we can see that today's market is very overvalued. What are the implications of this? Whenever the CAPE ratio is high, meaning overvalued, it means stocks are overvalued. Simply put, pretty face value. But it also means that returns over the next 20 years will likely be poor. Okay? So this is not just an indicator of where we're at today. This also typically has indications for the next 2 decades to come. Let's stress test that. Let's see if that's accurate. Well, if we roll back the clock roughly 20 years ago, we can see that we were dramatically undervalued. And then we had a couple decades where all of a sudden we had great performance and now we end up in overvalued territory. Okay? So I love this chart. I love this data. The Shiller CAPE ratio, I mean, Case Shiller in general has a ton of amazing data. And this is such a good illustration and easy to understand of, overvalued, undervalued. And the problem is this has 20-year implications much of the time. So again, let's dive into this data. Let's dice up that chart a little bit and see what this really means. What the CAPE ratio says is that the American stock market today appears to be overvalued by roughly 60%. In other words, it would take a 38% drop for the market where we're at this exact second. It would take a 38% drop to bring the market down to long-term equilibrium levels. In comparison, the peak of the dot-com bubble, so early year 2000, the market was 88% overvalued. So when the market bottomed out 2.5 years later from the peak in the year 2000, it dropped over 50% from its previous all-time high. We're near that territory. So that's where this starts to get a little scary. And again, to recap, what this is telling us is that the market is 38%. There's a 38% potential drop to get back into historical ranges and values of the stock market. So let's check in here. Do you think the stock market is overvalued? Ange dropped it in the chat. I want to hear from you guys. I want to draw attention to that. Do you think the stock market that we sit in right now today is overvalued? Yes, or not overvalued? No. Wow. Wow, pretty overwhelming. Andrew, thank you. Jeff, Jeffrey, Matt, Jim, Paul, Kevin, Jeff, Kirsten. Yeah, I mean, we have a ton. So looks, Michael, ooh, I like the uncertain approach. Relatively overwhelming response from everybody that yes, seems to be your guys' feedback as well. Very interesting. Okay. So now we know a good amount about the market drivers and how third-party experts are evaluating the market overall. But, we're all big boys and big girls, right? We're all investors. We know that investments have risks. All of them have risks. We even included that at the beginning of this presentation. And we know that the stock market, being an equity investment, based on appreciation most of the time, has big risks associated with it, right? And we as investors can make decisions about what we do with this information. That's part of investing. But always the biggest question is the assumption that is the market fair? When we take our risks as investors, do we have the same risks as everybody else? This game is fair, right? Well, right now, maybe not, okay? Because there are some people who have access to more information than we do about the market. And maybe they actually do have an unfair advantage in the market that we're sitting in today, which puts us as retail investors, as outsiders, not insiders, it puts us as at a major disadvantage. So let's talk about insider selling. There's a ton of information on this, and there's a ton of people drilling down on this. So we actually literally just decided to give you guys a link to a YouTube video. It's not our video, it's someone else's video. We don't make money off this or anything. It's just a dang good video, okay? And it's worth giving you guys that information. That's the goal here. So I'm actually just gonna drop this myself in the chat. You guys can check this video out later, but long story short, insiders are selling stocks at a record pace. And when I say record, I mean all-time high. Meaning, what do I mean by insiders? The executives and other inside C-levels and people in the know, managers, etc., key players at major institutions, at major public companies, they are selling at an all-time high for the companies that they work for, okay? These are the individuals that have insider knowledge of how their companies work that they are employed by. They are selling at an all-time rate. The current pattern of elevated selling compared to buying suggests that the corporate insiders may be this is a quote, may be exhibiting concerns about their companies similar to patterns observed in late 2024 when insider selling was described as occurring at the fastest rate in more than a decade. So simply put, when people who know the most about a company are making a decision, that's something that we as investors need to be extremely aware of. So as an example, at Saint, for instance, to give you guys, an example at home, I see what we do every single day. I'm involved in all major decisions at Saint. I have the ability to work with an amazing team. So when I had cash on the sidelines because a deal closed and I got recapitalized, I put more money into Saint. So I put over $500,000 in the last year or so into Saint because I know our underlying investments. I know our underlying strategy, and I know what else is going on in the marketplace. And I know that at home, I like what we're doing the best. On the flip side, in this example, these individuals who know the most about their companies are selling at the highest rate in history. So that to me is an extremely negative sign. They know more than we know, and they're making it clear that what they're seeing is not good.
Corporate insiders are selling at the most rapid pace in over 20 years.
We're not going to watch the video. I accidentally clicked on it. But I encourage you guys to check that out later. Now, am I full of it? Am I exaggerating? Am I misinterpreting the data? I would be remiss if we didn't go through the exact chart to back up these statements, right? So let me show you clearly exactly what I'm referring to. In this chart that we're staring at now, we see the corporate insider selling, the peaks, especially over the last, couple decades here. We are seeing all-time high for insider selling. This is extremely scary to me. Because the people with the most information are making a very clear set of decisions, and that is to sell. But maybe the investment pros know better than that. Maybe there's some insider secret track in the stock market where the smartest of the smart are making different decisions. Let's check in on that a little bit, right? What are the investment icons in the stock market doing with the data that they're seeing? Well, they are making moves, that's for sure. Let's take Warren Buffett. Uncle Warren has made major shifts in his portfolio. He's also expressed major concerns publicly. He's been pretty open about a lot of this. Buffett has moved 30% of Berkshire Hathaway assets into cash. This is the highest level in company history for Berkshire Hathaway. And Warren being a, investment icon, right? People joke about the Buffett tracker. What's Warren doing in the marketplace? Kind of like a secondary spot check on what's happening in stocks. Well, right now, the Warren Buffett tracker is showing an extremely negative outlook with major sell-offs throughout his portfolio. And he's a long-term investor, guys. So That would lead me to believe that Warren believes there's a longer term problem, something that's going to shake out for a longer period of time. This is just a good chart coming directly from JP Morgan Asset Management, okay? Spanning from 1988 to 2024. So this is a spot check on what the expectations are, moving forward. We included this in here just to give you guys another example of a good chart. Also, PE ratios, we wanted to show you the history. We wanted to show you that we are at the highest point in 30 years. Pretty shocking, way above historical averages. And what happened right around here? Well, that was the dot-com bubble. Not good. Another good chart. So in January 2025, the S&P 500 forward PE ratio was 22, which placed the market into pretty expensive territory. Historically, what we've seen is that when valuations are elevated to this degree, we typically saw long-term subdued returns. What that means, long-term, people aren't making money. When PE ratios hit these levels. So, typically we saw in situations like this, the long-term ranges of returns were averaging around 2%. A little alarming, but we'll see what some experts have to say. So what do the experts have to say? Some of the biggest names in finance, people that are trading day in and day out. Well, Warren Buffett, we talked about Uncle Warren a little bit, but what did he do? 127 billion in sales during the first 3 quarters of 2024. Warren and Berkshire Hathaway now hold over 300 billion in cash, meaning he does not have a better place to put that money than sit in cash right now, looking at the stock market, which is his chosen investment vehicle. You look at Jeremy Grantham. He warns of a cataclysmic decline. Why does he warn of that? Due to market overvaluation. Jeremy Siegel, he's a finance professor at Wharton, a well-known, very outspoken. He anticipates a deceleration in the stock market's rapid growth within the technology sector specifically. Robert Kiyosaki, he's predicting a crash. He kind of always predicts a crash, but he's been even predicting more crashes now. He has the best data he's had in years to predict a crash right now. So very, very outspoken on it. And Ayako, this is a quote from her. We've seen clearly a big sentiment shift. A lot of what has worked previously is not working now. So a fundamental shift in how the market is occurring and acting today. Let's look at some predictions from things like government agencies and some of the biggest investment firms in the country, aka the world, right? The Federal Reserve. You look at Fed Governor Lisa Cook. She compared the current market conditions to the 1990s. She used the term irrational exuberance. She talked about terms like highly speculative, overpriced, and dangerous market conditions that we are in today. This next one is one of my least favorite, but also one of the most important. Goldman Sachs. You know how we saw that chart and saw that when we hit PE ratios like we're seeing today, we're seeing around a 2% return for the next decade. Well, what do you think Goldman Sachs is predicting for the next 10 years? The Goldman Sachs 10-year forecast calls for total returns of 3% per year for the S&P over the next 10 years. This forecast indicates a 72% probability that the broad market index will underperform bonds. Haven't heard that in a while. And a 33% likelihood that stocks will generate a return that trails inflation, meaning you have all the risk of the stock market and you don't even beat inflation. You lose money to inflation investing in the stock market over the decade. And that is a huge percentage that they assigned to that. Then you look at Morgan Stanley, their CIO, their chief investment officer, Mike Wilson, the guy who literally sets investment strategy for Morgan Stanley, is warning of a decade ahead of flattish returns, based especially on the Shiller-Cape ratio. This is the head of Morgan Stanley's investment strategy. Okay. So across the board, whether it's individual investors, whether it's the biggest names in finance, whether it's the absolute experts, government agencies, Goldman Sachs, Morgan Stanley, we are seeing that people are digging into the data, and it's unanimous that at least a decade of negative returns ahead are what most people are betting on. So here's a question for you guys. Will the market continue to shrink? What do I mean by shrink, though? Let's clarify a little bit. This is a little tongue-in-cheek, to be honest, but will the market continue to shrink? The reality is something's been occurring in the stock market, something that we really have never seen in the stock market history to this degree, and something that has not been covered by mainstream media or mainstream financial outlets. The reality is the stock market has been shrinking, and we have not been hearing about it. Here's what that looks like. Today, there are 40% less companies in the stock market than there were in 1996. I mean, this is not a poll, but let me just check in. Has anybody ever heard this statistic? Has anybody ever heard that we have 40% less companies in the stock market today than there were 30 years ago? Drop it in the chat. I really want to hear from you guys. I had never heard this up until much more recently. So I was shocked to hear this type of statistic. In 1996, there were 7,300 publicly traded companies in the United States. Today, there are around 4,300 companies publicly traded in the United States. That is roughly 40% of companies. And Andrew, I'm going to touch base on that. Private equity, very interesting angle, and you're ahead of the curve there. But 40% fewer companies in the stock market today. This is driven by a ton of factors, which include less companies wanting to go public. It's not the same as it was 30 years ago, as far as a company looking at the highest pinnacle of what they could achieve. There's also a huge amount of regulation surrounding public companies, making it more difficult to operate. There's also major expectations from investors and from the investment community, forcing companies to rethink how they look at things like revenues to a quarterly basis, right? Short-term thinking rather than long-term big strategy. With 40% fewer companies, we see that not only do companies think less optimistically about the stock market, but we also see that investors have much less access to the best companies and the best investment opportunities. Also, 40% less companies means less diversification. So if we're investing in stocks today, if we're investing in indices today, we just have less diversification by a factor of 40% on the headcount of companies. And Jeffrey, that's right. So short-term thinking. Let's talk short-term thinking. It's a major problem in the stock market for companies because companies are often held to quarterly performance rather than a long-term outlook. So if a CEO has a few bad quarters, they may be out of a job. Very literally. So they are incentivized, at certain points. We use the term cut corners. I think that's aggressive, but it's the same concept. They're incentivized to cut corners at certain points and to show growth and force growth above all else. Think Boeing, okay? Think Enron on the craziest extreme, right? Think about the thousands of companies that have BK'd that we will never even hear about, that never really made it into the spotlight because they weren't thinking long term. So, in what ways do companies have to think short term? Where does this actually present itself in the marketplace? Well, you can sell more product more cheaply at the end of a quarter to boost your returns. Hey, you got to hit your numbers, right? You can cut certain investments as a company. You can cut long-term investments that may be a terrific long-term ROI, but show less investment or even take a loss in the short term. So you got to think short term and remove initiatives that don't have long-term opportunity. You can get really nasty and start doing weird accounting. You look at like the Enron mark to market, how they use some funky accounting there, et cetera. But that short-term thinking, I actually believe, is a huge risk across the entire public sector. So we had a few people message and allude to this. But let's peel back another layer here and let's see what exactly happened with all these companies. Because it's not that we have less companies as a country. We still are the premier economic powerhouse of the world. You compare us to Europe, you compare us to most other zones, we've crushed them over the last 30 years. So where the heck are all these companies going? Okay. If they're not going public, where are they going? The rise in private equity investing into companies has exploded during this same 30-ish year window from 1996 to today. So while stocks and the stock market have lost 40% of the companies, private equity has increased the number of companies by nearly 6x. Okay. So Andrew, you said BlackRock buying up all the good companies. It's BlackRock and it's a lot of others. Okay. It's a lot of others because we're talking a 6x increase in PE investment into different companies from 1,900 US companies to 11,000 plus companies to 11,200-ish companies backed by private equity. Okay. So we saw the reasons why companies don't want to go public, but there are also some pretty compelling reasons why companies strategically want to work with PE companies. Well, on one hand, they get strategic help and mentorship directly from people that might have seen this in the industry 100 times. They get to think longer term. They get to put longer term initiatives that maybe are expensive in the short term, but maybe have huge upside on the back end. And they get to make healthy business decisions, even if that means short-term losses. In the stock market, that is not incentivized. So over the past 25 years, we have also seen private equity outperform the stock market. Okay. It's not really that surprising considering that they have, the ability to think longer and make bigger plays and bigger moves. But yeah, and they have easier access to capital because if they have a big brother sitting there with a ton of cash and a big wallet, that's a nice strategic relationship, especially if that big brother with a ton of cash is very invested in your success. So there's some other notes here, but the big takeaway, companies are making the decision to not go public and they're deciding to stay private. So what impacts do we really see here? All in all, there are major shifts. I want to highlight this is a major shift happening, and this is weakening the entire stock market and strengthening the private investment sector completely. Okay. The current stock market is much less diversified. There's 40% less companies. The top 10 companies in the stock market represent roughly 75% of market value. I mean, that makes me sick, right? It's so not diversified. It's so tightly packed in value and in dollars there that it's huge. It's concerning. I'll just put it that way. Better opportunities for companies exist in the private sector, staying private, working with investment groups. The best companies, this is a highlight. What we're seeing is some of the best companies no longer want to go public, which means investors like us have less access to the best opportunities that exist in the market. That's the impact here. That is the number one takeaway. We as investors no longer have the same amount of access to the newest and best and brightest companies when they don't go public. This major shift on that point leads to better returns and better options with private investing. I really, really want to hammer that home. So we talked about a lot of different pieces of the market. We're going to zoom in on a couple different market vulnerability factors in equities today. People hit on this, but let's drill down. Let's make sure we touch base on this. Rising consumer debt. We see credit cards, we see auto loans, we see mortgages, corporate debt, refinancing challenges. As interest rates go up, many companies are looking at their debt double, things that is unsustainable, things that they can't afford, things that crush their financials. We see credit spread tightness, which kind of goes back to the debt discussion. So this is now to pre-crisis periods. This is a very, very tough place for many of these companies. Consumer debt. This is a painful one. One alarming trend that we're seeing is a massive spike in consumer debt. Okay. This is really seeing the root of many issues on the consumer side. These are debts in big categories. Excuse me. These are things, credit cards, these are auto loans, etc. The biggest consumer items are all on a rapid incline, So much, in fact, to quantify, that the debt of the consumer debt has increased by over 57% in the last 4 years. Americans have credit card debt exceeding 1.2 trillion today. Brutal numbers. Some of the causes include sky high interest rates, inflation, which we've talked about many times on many different webinars, and other economic factors. But credit card balances are likely to continue to climb. We're not out of the woods yet. Also, let's drill down on auto loans. Auto loan debt has risen by over 73% over the last 10 years. That's the takeaway. Car costs have also soared, and the whole auto industry is drowning in debt with a huge amount, 73% increase over 10 years. Subprime auto borrowers are past due on their loans by over 6%. This is defined by being over 60 days past due. This is the highest level since we started tracking this data roughly 30 years ago. Okay? Not good. This is a very high level. Corporate debt and refinancing challenges, like the difficult things that companies are going through, specifically in the stock market. Despite strong economic growth in the past, labor market strength in the past, and tight credit spreads, we have seen persistently high interest rates. We have seen that even then, persistently high interest rates will strain the credit quality for most US companies. We see this more than ever in 2025, okay? The average risk of default for US public companies reached a financial crisis high of 9.2%, record high at the end of 2024. It's predicted to remain throughout 2025. This is by Moody's, by the way. I'll cite the source. This is from Moody's Analytics, the Moody's asset management research team specifically. So these problems are looking to persist. There is not an end in sight. Again, we kind of touched base on the credit spread tightness, but we're on the longest widening streak of credit tightness since 2023. When credit spreads widen, it typically indicates that the fixed income market is pricing in higher risks. So this is often a leading indicator of the equities markets, aka the stock market stress. So when we see these numbers, we see stress, a precursor to problems in the stock market, just another indicator of problems to come in the stock market. So we went through a lot just now. We've been through a lot of different details. It wouldn't be a Saint webinar if we didn't make some bold projections of what we see in the future and get more specific with you guys. Here's a few. The stock market, we believe, will continue. We will see a shrinkage of the stock market ongoingly. We will see the number of companies going public shrink. We will see that gives us less diversification and more risk. We will likely see a higher concentration into less companies as a result of that. We also believe the best investment opportunities will continue to become increasingly non-public. So the takeaway there is, as private investors, all of us individual investors, to make sure that you know what your game plan is if the stock market continues to shrink and become less diversified, and or performance ahead of around 3% like Goldman Sachs is predicting. We also believe that the smartest investors, the most strategic investors, will have an extremely higher return profile and better opportunities than the traditional investors, the people that are investing in things like stocks and bonds in today's market. And I don't think it'll even be close, candidly. What we see on our side unsurprisingly, is that real estate and real estate debt are likely to be the absolute winners over the next decade plus. So to quantify some of these for you, what we're seeing, very likely digging into the numbers that we just all went through together, that the smart investors, the people that take advantage of off-market opportunities that are less in the traditional markets and more on alternative, will likely have 50% higher returns, right, than their counterparts. We're talking, instead of a 9.2% average, which is just basically a historical average of the stock market, which we're expecting probably a lot less, we see around a 14.2% return over the next decade for alternatives, depending on what you choose. We also see that alternative investments, well chosen, have probably a 2%, or excuse me, have a 2x protection against volatility. So will be half as volatile as the public markets. Just some numbers from our own analysis that we see over the next decade. So this is about you guys. We can talk about the markets. We can drill down on the numbers. I can geek out with you all day long on the economics. But most importantly, what do you do from here? You've heard some of this, but it's more important than ever. Diversification principles, right? It's spread investments around different sectors, different industries, and different asset regions so that you're not overly exposed to one neck of the woods. Oh, I love this. This is a great question that Ange just asked. I want to drill down on this. What diversification strategies are you utilizing? Are you buying more stocks? You buying more real estate? You buying more cash? You buying more crypto? You buying more treasuries? Let us know in the chat what you find is the best diversification strategy that you're utilizing in today's market. Also, balancing high growth potential with stable income. We see this as a huge opportunity moving forward, is to lean into fixed return investments. Whatever you prefer there on the fixed income side, that will become an increasingly more important part of your portfolio along the way. Also, uncorrelated investments that are not directly correlated and don't move in the same direction. A huge investment strategy, especially in volatile times. When that VIX goes through the roof, stocks and bonds being correlated, maybe not the best things to be putting together. Also, maintain some guaranteed investments. Maintain some investments also that have assets that back them up. Equities are great, but if a company BKs, that's a concern on its own. So another good example of a Gallup poll, right? A big polling agency. They did a poll, and what they found was that 18% of investors believe that stocks or mutual funds are a better choice in today's market environment, as opposed to 34% think that real estate is the best investment for a long-term investment. I love this. It's very interesting, and it gives us insight to, our investment community. Tactical moves for 2025. Strategic rebalancing is the name of the game. That while market volatility is all over the place, ups, downs, all over, what we're seeing is that historically, things like buying the dip, strategies like buying the dip worked. Why? Because the assumption was that the stock market was always going to come back, right? It was buy the dip, don't fight the Fed, right? Now the Federal Reserve's coming out saying that they don't expect good things for the stock market. So when the Federal Reserve, you go back to the fight the Fed policy, buying the dip is not the same strategy as it was when the Federal Reserve had the most confidence in the stock market. Just to put that out there. Also, fixed income investing, we touched base on this, but it rounds out your portfolio in a way when volatility is crazy that you make sure you have an idea of what you can expect, something fixed, something that is firmed up versus just being 100% equity or appreciation based. So, one big note, just to oversimplify this, if you guys are in stocks, we urge you to be cautious and diligent and to consider diversifying your portfolio. It's wild out there. Even the biggest investment pros, the Federal Reserve, Goldman Sachs, Morgan Stanley, they don't even have good things to say about the stock market today. We dug into what the numbers behind that look like. So guys, highly, highly, highly encourage you to take a look at your portfolio and consider diversifying a little bit away from stocks. Also, optimizing your investments, making sure the returns you're getting. Here's a question. This is off script. Here's a question we get regularly. People ask about treasuries, right? Hey, should I do treasuries, right? Should I do treasuries at 4%-ish? The conversation we usually have is just, well, how much are you trying to make? Well, I want a really safe return. Well, if treasuries pay 4% and inflation's at 3%, what's your spread? It's 1%. So if someone is comfortable with a 1% spread, then that's good. Others see a 1% spread as a massive amount of risk because when inflation ticks up, they're breaking even at best, right? So optimizing your investments, just to check in with you guys, optimizing your investments oftentimes means shoring up your returns and making sure your portfolio has blended returns that are at a safe place for you and your lifestyle. Diversification we touched on as well. At the end of the day, the goal for most investors is an all-weather portfolio, right? We talked about uncorrelated assets. We talked about fixed income as well as appreciation, aka equity, aka different models of investing where you can balance out the risks of each, right? Alternatives seem to be the winner over the next decade plus. We've seen a ton of data on that, and it seems to be the most optimistic, even from who was it that said Blackstone earlier? It's you look at Steve Schwartzman, right? Steve Schwartzman, Blackstone. I would dig into some of his comments where he's seeing a huge opportunity in real estate over equities as well. And then tactical shifts. Guys, tactical shifts occur when you see the market data and you see how to get ahead of it. So hopefully the things that we went through today for y'all really help you get an idea of where specifically the turmoil in the stock market is today, where it's coming from, and where it is likely headed by many of the best groups and what their expectations are. Matt, I see your question. We're going to dive into that in Q&A. I love that question. So one of the things we'll talk about here, real estate can have the advantage of paying a fixed income structure, right? So if we're talking about an all-weather portfolio, there are real estate options that benefit on kind of both sides of the coin, and it's all about the underlying assets. So our solution to that problem, our solution to that question of an all-weather portfolio, it centers very heavily around fixed income generated by real estate. So for instance, let's talk rates. That's an obvious example. It's one of the questions that we get the most. So if rates go up, then mortgages in a portfolio, fixed rate mortgages, 30-year-ish fixed rate mortgages are actually more stable, because if they're at mortgages at a 6 and the rate's a 7, they're not likely to refinance to a higher rate. That's why we see the boomer demographic right now locked into their homes, because many of them are in 3% rates, right? Huge portion of the country. So if rates go up, we like mortgages because mortgages are more stable as rates rise. There's also less refinances. So it's a more stabilized portfolio over time. There's less turnover in there. Cash flow is more stabilized with less refinances and with less likely to refi on that side. And there's less turnover, so it just provides consistent returns. On the flip side, if rates go down and you're, let's say, a mortgage portfolio owner or investor, it stimulates buying. So often property values go up, which often means that people are selling more, which means that, in our case, we get paid off earlier. So refinances or payoffs are completely fine. It actually boosts our returns. And then our fund, because it's evergreen, we just reinvest back into the fund. It expands the asset base. So I like, especially real estate right now, especially mortgage investing right now in this environment for an all-weather strategy, because it really adjusts well with rates being higher or lower, as long as you're shored up on your strategy in the market. So that's what we're seeing as the best opportunity for an all-weather strategy in the real estate space today. And if you want to learn more about us and our income fund, the Saint Flagship Income Fund, here is a good place for you to check that out. Also, Ange, can you drop the, there we go, the link to book a call with our Director of Investor Success, Luke. He's happy to walk you through the details of what we're doing, how we're doing it, and why we're doing it. And again, that's backed up by over 500 single-family mortgages in over 21 states. We pay up to 14.28% returns annually, depending on the depending on the share class that you choose. So happy to do a personalized investment strategy call with you with the link that we just dropped in there. You can also hit the QR code there and take a picture of that, or you can text wealth to 949-787-0957. Also, we do these regularly. We do these every single month, these webinars. We have a huge repository of deep dives on economic subjects, investment strategy breakdowns. I mean, last month we went through exactly how we invest in notes. We went through our exact due diligence process. We went through our exact strategies. Many of these last for, really deep dives, hour and a half, 2-hour webinars on amazing topics. Check out our YouTube channel. There's so much good information there. We give all of it away for free. We're already doing all the research. So we figure we just share it with you guys.